So now let's move to our financial model. So at this moment, I use for this session, I select the Saudi petrochemical sector, and our target company is Gulf Chemical Companies. So means it's a private company. So on that private company, we will do the apply the comparable multiples and calculate the value of the company. So for the comparable companies, I have selected these comparable companies: 𝗖cie𝗺𝗽𝗀𝗃, 𝗪𝗏, 𝗃𝗵, 𝗏𝗀, Petrochem, Advanced Petrochem, Nama Chemical, and Sahara International. And for each company, I have explained a little bit about their industry, about owned by who owned this, and what are their main sectors. So means we need to, for the user, if we are giving the value of the business, we do not just have to identify the peer, then just give them the number. We have to defend them. So always we need to give a short description about the company, comparable company, what they are doing. So means by reading that short description, user can understand that is actually in the same pair. For the assumptions, I already have the financials for the Gulf Chemicals. Means this is just hard coding numbers. I will go step by step. Means what are the numbers. So for this, we can also use the same numbers for our three statement model. Means we can use that number as well. So means if we understand the process properly, so then any kind of industry numbers, any kind of company numbers, we can apply and calculate the valuation through comparable. So valuation date, suppose our valuation date is 31st December 2025. Our currency is Saudi Riyals and our sector is Saudi Petrochemical and Basic Materials. So here from the company financials, I have extracted the last 12 months financials of the company. In the last 12 months, revenue for the company is 1.8 billion. LTM EBITDA last 12 months EBITDA, last 12 months EBIT, last 12 months net income, and last 12 months EPS, earning per share. If we need to compare any analysis, so we can use that EPS as well. So means every multiple we have that total revenue 20%, EBITDA margin, earning before interest, tax, and depreciation. Means every formula have an explanation that what is this. So next we have the capital structure. As we calculate from the market value, we have to go back to the equity value, enterprise value, or the enterprise value. We have to go back to the equity value. So we need the financial income statement information as well as the balance sheet information. So these are line items which is required. Means like for the why I said that it's easy to apply, means we just need the few numbers to apply this one for our target company. Like for DCF, we do the full financial model. We calculate full income statement, revenue, COGS, G&A, everything we are calculating. But here we have the historical numbers and we just applying this. Like for the in our if we see our income statement, we need four line items: revenue, EBITDA, EBIT, and net income. And for the balance sheet, we need the total debt, interest bearing debt, whatever the debt in the company. We have some kind of related party payables. If these are not interest bearing, so it will not be our debt. So we will get only the interest bearing debts, spook, revolving credit, means bank overdraft, long term loans, short term loans. Then cash and cash equivalent. So means whatever the cash or cash investments available in the business. So this will be about cash. Share outstanding. So for the private company, mostly number of shares not available. So but for that means we can also use the this one as a applicable method. Means if we want to calculate the exact number per share value of the business, we can assume any kind of number like 100 share of the company, 200 shares, or 2 million shares, whatever the number. So we can exclude this one for the private company. This is not required, but you can give the number to if you want to see the one share value. Book value of equity means what is the equity value in the business. So means from the financials, we are getting three numbers only. One is total debt, cash, and equity value. This one is not required. If you want to add a further enhancement, you can do, but it's not required. Then we just calculated the net debt, because in the enterprise value, we adjust net debt like minus debt plus cash. So we adjust that. So on the base of that, we get to the our net debt. So our net debt is total debt minus cash. So we have the net debt which is payable for the adjustment into our valuation. So next we have the level of value adjustment, which we already discussed. That we will once we cover that in the our theoretical part, then we will discuss this one, how to apply and what will be the ranges. So for the comps table, so here we have the company, ticker, city or based in, market cap, total debt, cash, revenue, EBITDA, EBIT, net income, and book value. So means whatever the information we need for our target company, the same information we required for the listed company. Like for the listed company, for the SABIC, it goes to the Saudi exchange. I take the market cap of the company. So means what's the market cap? So it's a 258,000 million. Okay. Then debt of the company, total interest bearing debt. This is from the historical financials, last 12 months financials. Then cash, closing cash of the business, means what is the closing cash of the business, also the closing of the business. Means for the LTM, we always use the balance sheet items closing for the closing period, but for the revenue item, we go back to the last 12 months, because balance sheet shows the current value of the as of today, but for the income statement we have to for the period, we have to consider for the period. So first of all, we have taken these three numbers from the company financial. Then revenue, as we all need to get the revenue for our company, same we get the revenue for the comparable. EBITDA, if EBITDA is not directly available in the company, so means some companies are not reporting in the financials EBITDA, so we have the EBIT. So we will add back depreciation and amortization, so we will reach to the EBITDA again. So EBIT, earning before interest, tax or over operating incomes. Then we have the net income. And last, book value, means the equity value of the company, whatever in the company books. So same we have calculated. I have got the numbers for all the companies, all the 8 companies from the company's financials. Now we will calculate step by step. Means this is the hardcore numbers. Everyone can get these numbers from the financials. So the main thing is to calculate the values. So like we already discussed that from the listed company, we get the market cap. First, for the EV multiple, enterprise value multiple, we need to get it just back to the enterprise value. So our formula will be like from the in the enterprise value, we were deducting debt plus cash. So we reach at equity value. Here we will go opposite. Equity value, market cap plus debt minus cash. Okay, so we get the enterprise value of the company. So we just need to drop and drag the formula. One second. Okay, we do one thing. Okay, so we just bring it to the other sheet. View, there was some error in the tab. So Okay, so for this we get the enterprise value of the our company. Enterprise value of the comparable company. Now we need to calculate this one. We get for this one enterprise value. Then same way we will calculate. Now we will calculate our multiples for the price to earning, price to revenue. We already have the market cap, so we don't no need to calculate that step. So for the enterprise value multiple, so what will be our formula? Our enterprise value divided by revenue. So here we will anchor the row for the enterprise value because we need to drop and drag the formula into the next. So sometimes if company have a negative or there is a no number, so like if I say that it's a no zero no value, so it's a div error. So we always need to apply the if error formulas to, so our financials need to be clear. Okay, we can say that 0 or any kind of numbers. Okay, so we calculated multiple EV over revenue multiple, enterprise value over revenue. Same multiples we will just drop and drag the formula, so we get the multiple for the our enterprise value divided by beta, enterprise value over EBIT. So we get the multiples for all these three items. Now for the price to revenue, in the enterprise value we use the enterprise value and then here for the price we will use the market cap. Market cap divided by same over revenue, and same we will just here we also need to apply the if error. If there is some error in the sheet, so it can be ignored. So we calculated our multiples. So you see just a simple steps to calculate the multiple. If we have our data aligned, well managed, so we can calculate the multiples in just 5 to 10 minutes. So means that the main thing, the first of all, the main critical thing to extract the data from the company financials. If we this is our base. If we extract the data wrong, so overall means calculation, there's no benefit for that. So main thing is to extract the data from the company financials. Now we have calculated our multiples. Now we already discussed that we need to calculate the ranges of the value, means the multiples. If we just not need to apply the one multiple, like if we see that our SABIC EV over EBIT is 14.7, but for the advanced petro is 5.4. So means there is a big gap in the numbers. So we need to give the ranges. So and at the end we will select, we will do that which number we have to use for our value calculation. So first of all, 25th percentile means from the lower 25th percent, from the lower side 25th percent, like not the low not the high, but from the lower side 25th percentile we need to calculate. Percentile into range. I will log the range because we need to just we will drop and drag, so we can use that as well. Means we are calculating 25th, so it's 0.25. So 25th for these multiple, let me log this one so we can see what's going on. Okay, so we calculated 25th for this for all the companies, and for the also for the price multiples. From then median, we will calculate the median. Same for our all companies. Priced and then. Now here we need to use 75th percentile. Okay, so we get the 75th percentile. Okay, so next, mean is our average. What's the average? So means it will give us clear picture that what each parameter shows us for the multiple. Okay, then high means max. Which company have a maximum multiple? So what's the maximum multiple for? Okay, if we get the maximum, now min. Okay, we got the all the multiples calculated. So means it's an easy steps to calculate the multiple if we know the formula how to do that. Means the formula is already clear. Already explained us EV over revenue means EV enterprise value divided by revenue. So means it's already multiple explain itself that what's it, and then we just need to apply the ranges. Means how we have calculated the range. Okay, so now we get the we calculate our ranges for the multiples. Now we have to apply those multiples on our comparable companies. So means our company. So we will get the same data from for our company. Okay. So now we need to take the target company numbers. Like we already have the hardcoded numbers for the target company, so we just need to bring it here. Assumption sheet, our target company, LTM revenue, LTM EBITDA and EBIT. So means we have three metrics, so we calculate that. For the market cap, we have the multiples. Now we have to calculate the multiples. Means on the market cap, what are our multiple on the market cap and what are our multiples on the enterprise value, on the low multiple and high multiple. So we can first we will get the multiple, and then on the base of that we will calculate step by step our valuation. So our low multiple, what was our low multiple? Means there is a different criteria we need to use. So like if we use the low, means it's a minimum of the range. If we use the high, it's a maximum. Median mean is the average. So but here we are taking the different approach. Means not the low, not the high, it's a mid of that, like from the lower side 25th and higher side 75th. So means we can apply multiple items on multiple approaches on that. First is our at 25th percentile. We have this multiple for the our EV over revenue, for EV over EBIT and EV over EBITDA and our EV over EBIT. We just linked with our calculated numbers. So we have calculated numbers. So now at the lower side we will get the value of the enterprise value. By multiplying the multiples, we get the value of the business at a lower side. So now our mid multiple is median. Okay, so we had the median, then same criteria, our target company financials multiplied by mid-range multiple. So we have this one. Now same on the high side, we are assuming 75th. The same formula. Okay, so we calculate the multiples. So why I was saying that we need to anchor at every step, we need to anchor the formula. So we can just copy and drag. So here I applied the formula in every step separately. So just if revenue column multiply by this multiple will be changed, so our revenue or EBITDA will remain fixed. So we just need to copy and paste everywhere, so our multiple calculated. Now on the net debt, so what net debt is our hard coded number from the target company financial. So we will just go back to assumptions. So this is our net debt. We already calculated debt minus cash. So we have, so it will be same for all the multiples. So now we will get the equity value for the low, medium, and high. So what's the equity value for the low? Enterprise value minus net debt. Medium minus debt. Enterprise value at high minus debt. So we have the value. Now if we have a number of shares, like there we are assuming the 70, for example, if we assume that the number of shares is used for all pre-calculation share. Okay, number of shares we can calculate. Duty share outstanding. Okay, these are the duty share, not the SAR. This is the numbers X. Okay, so we say that 75 million shares if we have. Okay, so 75 million shares. So we calculate this divided by number of shares. So we get per share value. We need this divided by our first low, then we will move forward. Okay, so we calculated all our enterprise value multiple. First we calculate the comparable companies multiple, then we calculate the ranges of the multiples. So now if we see the ranges, why we choose that? So now if we see that, like our mean is giving an average which is beyond this range. Our high is on a higher side. If we use the higher number, so means we are overstating valuation. If we use a lower number, so we are using the understating the valuation. So that's why we use the median and mid numbers. So it's giving a proper range to us that these are numbers are flexible and adjustable, means as per the comparable companies. And then we calculated by applying the multiple into our target company financials. We get the enterprise value, then adjusting back the net debt, we get the equity value at low, high, and low, medium, and high level. And then by dividing into number of shares, we get the per share, means the multiple on the share basis. Means like we get the share price of the company. Here we get the full company price, equity value of the company. Now if I want to sell the company, if I go that, I will say that at the revenue multiple, my valuation range is 1.2 million to 1.5 million. For the EBITDA, I will say that my valuation range is 1.5 to 2.3 million. So these are our ranges. Now when at the decision making, so we give the weight to these ranges. That this is a different means the level that how to adjust that means that the decision making is not dependent on one multiple only. So they apply the multiple range, multiples, and then give the averages to all multiples. So we get the net equity value, one equity value of the business. So now we covered our enterprise value multiple. Now we have our multiple for the comparable. Price multiple. So same our numbers or same means like our revenue, EBITDA, our revenue, price to earnings. So here we will not take EBITDA and this because the metrics are different. Price for price over revenue, so means we will use the price. Our price over earnings, we will use the net income of the business. And then for price to book value, we will use the equity value of the business, book value of the business. So now first we need to get the multiples from our calculated multiples, like for the this our low multiple. So we get the price to earning multiples for the low side. If we want to verify 0.6, 3.4 and 5.1, 0.6, 3.4, 5.1. So our low. So same way we will get the our multiple for the median. Okay, and then we will get our multiple for the high. So we have all the multiples here. Now just we need to multiply our target company financials, multiply by the multiple lower, medium and high. So we get the all three levels, we have our valuation. So now here we directly get the equity value of the business. We did not get the enterprise value, means here we will not adjust our net debt because we already applied the equity value multiples. So we directly reach our equity value. So now all levels we get our valuation of the equity value, low, high and median. So what we will do, we will just apply, let me bring it here as well. So means we can see the same numbers, like we already calculated, but just for the presentation point of view, I just adding it here. So we just can apply the formula same way. So equity value and this one is equal to, just I'm linking it here, and these multiple. Okay, so this is our valuation, the same, no adjustment, I just for the presentation to make it easy, so I just bring it here. So now our share price at low, we will use the number of shares. So we have the price on need multiple. Now you clearly see for the all the multiples, it's give us ranges. Now for the only book value multiple, the range is little bit weird, means like it's not as compared to the other, means it's outlier. We can say that it can be outlier on the book value, means like it's stating that our equity value is too high, but our company book value is low. So means they are not parallel, going parallel. So means that's why the multiple is very high. So price to revenue, price to earning, we can say that price to revenue multiple are in range is in EV multiple. Okay. So now we have calculated our all multiples, our valuation of the business. Okay. So up to this clear, means how we have to get the financials, how we have to calculate the multiple step by step, and then how we have to get the ranges by applying 25th, 75th, median, mean, low and high. We get all 6 parameters, and all 6 parameters showing us means which are effective. So it's clearly giving us observation that which multiple we have to use, indication that which multiple we have to use, means which level we have to use, and then applying it to the company financials. We get the enterprise value, then we just debt, we get the equity value on the EV multiples, and then for the equity multiples, we directly multiply with the company financials, we get the equity value of the business, and then we divide it by number of shares, so we get per share price. So at this moment we have calculated step by step that our comparable approach give us this level of number valuation or number.
Take the median multiples. Why do we have to take the lower and high?
No, I just said that we did not take low and high. We exclude that low and high. We are taking the range.
But still we calculate.
We still calculated that, for example, if I have to present someone this, I cannot present this sum in a presentation. So I just use that for the fabric. These are their multiples. On the lower side, higher side, and this one means we use 8 companies, and on the 8 companies, these are our lower multiple, high multiple, and this one. So means just to give the just by looking into the slide, give an idea to the user. So what's going on in the industry? So that's why we calculate every level. Okay. So here we have calculated all multiples on the base of that. Okay. So next we will go back to our again or to our financials, means our slide, and we will then see how it's going on with the other things, means like the remaining things. So we calculate our price multiple. Here in the price multiple, we just identify a little bit mistake on the low and high multiple, like for the applying multiple. For the low multiples, our low multiple is this one, 25th percentile. So it's this one is okay. This one mid multiple, there is a issue with the mid multiple. We need to check, like if you see the mid multiple giving us a higher value and the high multiple giving us the lower value. So we need to identify that what's going on. So mid multiple, we will same take again mid multiple. We will apply the mid multiple again. So this one was wrong. So me here mid multiple. Now for the high multiple, so high multiples again we will link with our so now we can see that on the low multiple we have a low value, mid multiple mid value, and the high multiple high value. Okay. So we calculate our all valuations. So now we will go back to our slide and we will say next. Up to this, anyone have any question, any confusion? Means if you want to understand, so let me know. All good.